Hello, I'm Evan Liddiard of the National Association of Realtors. I'm joined today by Peter Baker, CPA of the Business Planning Group here in Washington, D.C., and we're going to talk about year-end tax planning. Peter, as the end of the year 2014 approaches, we're hoping you can share with us some thoughts as to why a realtor would want to meet with his or her tax advisor and talk about things that can be done before the end of the year as opposed to waiting until tax time next year. Thanks for being here.
Evan, good to be here. This time of year, December, I would have typically met with my realtor client on 3 previous occasions. And so typically this would be the 4th meeting of the year.
And this is estimated taxes you're talking about?
That's correct. And so they're required as independent contractors to pay as you go, if you will. And so this December meeting is merely a chance to look back at what's transpired so far this year and then forecast how we think the year is going to wrap up. And in that regard, we start with commissions earned. We use Schedule C as our guide. And starting with commissions earned, we will go to the brokerage office report for commissions earned year to date. Typically at this point in time, we know commissions earned through November. And then we will look at the pipeline or forecast of what they expect December commissions earned to be. And out of the combination of those two, we basically have the top line of commissions earned for the real estate agent for that year.
Well, that's the income side. What about the expense side? How do the expenses of a real estate agent come into play in this equation? And isn't it true that expenses will play a double duty by reducing both the income tax and self-employment tax?
Virtually all the tax planning opportunities occur on the expense side of the equation. And in that regard, best practices come into play. And for the more experienced real estate agents, they typically have a separate bank account to capture their business activity through banking. Additionally, most agents for meetings and scheduled appointments and things of that nature keep a log. These logs are very helpful to both substantiate who they met with, business purpose, in particular for meals and entertainment, as well as a log of what their business miles driven have been. Thank goodness the years of the shoebox are gone, and the best prepared and the best advice can be given, the more information that realtor can have.
And this saves money in tax preparation fees too to have this all separated out, doesn't it?
Well, it absolutely does. It makes available to us all the expenditures that have occurred, and we can analyze them in the context of what's ordinary and necessary and supportable to the business.
Well, Peter, what is self-employment tax and why is it so significant to independent contractors like realtors?
Well, that's a good question, and there's a lot of confusion. A self-employment tax, to be clear, is not an income tax. It is really the Social Security and Medicare tax combined, and the total of which is nearly 15.5%. So in the world of the W-2s, half that's paid and withheld. It's all withheld, but half of that is paid by the employer, the other half by the employee. Well, in the self-employment, sole proprietor world, all of that falls on the realtor to withhold those taxes.
And that gets to be a big number.
That 15.5% as a round number is a big number. Now, to kind of put them on equal footing with employees, the sole proprietor is allowed to deduct half of their self-employment tax on page 1 of their Form 1040.
As this meeting takes place, what if it becomes obvious to everybody in the room that there's going to be a lot larger tax liability than either side planned on? Is it too late to do anything at that point? Or is there still some steps that can be taken before the end of the year to cut that liability down?
Well, it's December, so not a lot can be done, and the best tax planning occurs throughout the year. But if we're faced with a result in December that neither of us are pleased with or like, there are a few things we can do. And again, on the expense side of the ledger, what we look at is typical recurring business expenses. Supplies would be a good example. And if they customarily restock supplies in January or February, we would look to accelerating those expenses, bring them into the current year. That would have an immediate reduction on their Schedule C profit. Under the tax code, there's currently what they call a Section 179, which is a taxpayer election to expense a capital expenditure in the year of purchase. And that is as opposed to depreciating it over the useful life of the asset.
So does it make sense for a realtor to go out and buy a new computer even if they don't need it, just to get the deduction?
No, absolutely not. And I want to be clear, I would never advise a client to go out and spend the money just to get the tax deduction. You're spending 70 cents in order to get the 30-cent tax write-off, and that doesn't make sense. You should always look to the business purpose and the need of the business. And if it's there, and if it's something that's planned in the near future, there's an opportunity then to accelerate and bring that purchase into the current year.
Well, thank you, Peter. This has been very helpful. Appreciate you
Enjoyed
being
it,
here.
Evan. Absolutely.